There's a follow-on question about earnings surprises, right?
Yeah.
Which I think people are anchor on, right?
Yeah.
Earnings do better than expected, but they're still slowing, which is
Yeah.
the point everybody's missing.
Yeah. Well, here's a good way to maybe think it through. And Jonesy, you're bottom-up analyst. You run our research team. You get it, obviously. Man, you're sitting at the epicenter of the revolution.
Yeah.
So if you get a stock, the thing is that they have a recency bias. And it's nothing against you personally. I mean, you're a human being. But you have so much baggage that you've had over the years watching, like imagine your life's been, and I'm assuming a certain percentage of you, it is true. You've been reading the Wall Street Journal and watching CNBC. I mean, that's tough. What you want to do is really like the whole Hedgeye idea is to run money like a hedge fund manager or a professional alpha generator, which is far different than the journos on TV, isn't it? So what you want to understand is this whole idea of earnings being discounted by the market. Future earnings, okay? So if you take something simple like let's just say a company, all right? Let's say the company's name is XYZ before I get a bunch of people upset about what the company's doing. So if this is time, over time, let's say that 9 quarters in, U.S. growth's accelerating, profits are accelerating. And here's the stock price. Every quarter, you get 1, 2, 3, 4. Let's say you have 9 quarters in a row of that, all right? So the stock does this. Eventually just discounts the peak earnings number. Then all of a sudden, oh man, earnings are going to slow. So and again, we would qualify earnings slowing in the S&P 500 when earnings go from 26% year over year. Even if it went to 25, I'd call that slowing. Not a lot of slowing, but currently we're at 14, so that's actually a lot of slowing. 26 minus 14 is a lot. All right. So again, you get the stock starting to go like this. Oh man! But by the time, don't worry. As this period of time, intra-quarter happens, next couple quarters, the company will just take down their numbers. All these fancy bankers and Wall Street analysts will take down their numbers. And then they'll come out and they'll beat the expectation of that number. So then you got Joey Kernan or somebody like, holy moly, Mike Santoli, they beat the number. Stock's up. Oh my God, it's good. Not good if you bought it up here. Right? Not good. So if you buy the stock, let's say that the stock went to 10 and you sold it at the peak, like we sold all of our growth exposures, every bloody one of them, all right, in the end of September. Let's say you got a bunch of stocks that went to 10. Then they go to 7, all right? Then they bounce to like 8. Who made money? Show me. Who made the money? Who made it? Get it? Beat expectations off a low base, but now what you got to do is you got to deal with the next 3 quarters. Are they going to be green or are they going to be red? Again, it's expectations do matter, but getting the broader moves on the earnings cycle is far more important because you're not justifying your losses with, oh, but earnings were better. I mean, that's kind of like how excuse makers deal with things or people who are unaware of how to do this altogether.